Hey Dr. Ravi, this is Jeffrey Howard here today to have a quick discussion with you about mergers and acquisitions. I'll start by distinguishing the motivations of two different types of buyers and what they might be looking for. The first type of buyer is a strategic buyer. They're typically going to be an operating business that looks to purchase another operating business, and the goals could be to increase market share or enter a new segment of the market, or perhaps just to exploit synergies, maybe by eliminating redundant processes. Uh, the first thing that we might look for in a strategic acquisition is the domicile of the acquired company. If we have overlapping processes or activities in a certain geography, we can cut costs by eliminating overlapping functions. The second thing we want to look for, especially from a tax perspective, is maybe the acquired company has net operating losses that they've been racking up that they've not been able to deduct, perhaps because they've not been profitable enough. Now, in the merged company, we're going to be able to use those, as well as perhaps some tax credits that we could operate with the merged company. We're going to want to be thorough about maximizing the benefit of those. The third thing that we're going to want to look for is the effective tax rate of the merged corporation. It might be different than either player had seen before. It may be higher. And that's something as tax professionals that we just want to be aware of. We want to kind of forecast where we think we'll stand. The goal of a strategic acquisition is going to be to implement the acquired assets and processes as seamlessly and effectively as we can. A financial buyer, on the other hand, could be a hedge fund or a private equity fund or a private equity firm, and they're going to look to acquire a business perhaps for 3 to 5 years, and then turn around and sell it, or maybe take the company public and do so for a profit. So it's an investment. The first thing that financial buyers are going to be looking for, especially from a tax perspective, is going to be the effectiveness of cost recovery and interest deductions. Uh, if we buy assets in a taxable transaction, perhaps we're going to get a step up in basis, so we could have bigger depreciation or amortization deductions. And I'll talk about a leveraged buyout a little bit later. If we use that debt to buy another company, we're going to want to use the interest deductions to our maximum benefit. We also, from a tax perspective, want to make sure that we keep it clean so that we can sell as seamlessly as possible this business in that 3 to 5 year window down the road. Uh, I now want to talk about kind of a case study, assuming that we're working for a mid-sized U.S. firm and we're looking to enhance our manufacturing presence in Asia. Uh, there are three things we can do regarding an Asian manufacturing firm. We can do a stock purchase, an asset purchase, or a merger. In a stock purchase, our firm in the U.S. will pay cash or other consideration to the shareholders of the Asian firm for all of their stock. We will acquire all of the firm's assets and liabilities, so it's important that we perform thorough due diligence to understand what kinds of contingent liabilities and even hidden liabilities that we may face. Uh, an asset purchase, on the other hand, has some nice features in that we can pick and choose assets and perhaps liabilities that we want to take on. But if we know what we're getting, we don't quite have to be so diligent in our due diligence. Uh, we do need to be aware that if we do an asset purchase and we move assets from nation to nation, we could be facing transaction taxes that can be substantial. The third type of transaction that we could pursue would be a merger transaction, where our firm, along with the shareholders of the Asian manufacturing firm, would work together to govern the newly created firm. We should be aware that both us and the shareholders in the Asian firm are going to be interested in performing substantial due diligence, because we're going to have kind of a shared fate where we each own stock in the newly merged firm, and we're going to want it to be successful. Uh, we also, we need to be aware that in a merger, we're going to assume all the assets and liabilities of the acquired firm, so we have the same risks as a stock purchase. The nice aspect about a merger here would be, perhaps it would effectively allow us to utilize, the local firm's shareholders' knowledge of, you know, doing business in Asia, dealing with the governing bodies, and also perhaps we'd like to start selling in Asia, and their knowledge could certainly be helpful as we strive to expand. A second case I'd like to talk about would be if we can assume that I'm the vice president of tax at a global corporation, and we're looking to expand into the Midwestern United States. There's going to be a laundry list of things that I'm going to be looking at from the start that we're going to be looking at throughout the entire transaction. The first is going to be the tax benefits and cost, and also non-tax characteristics of a various locations. So say we're looking at Wisconsin or Iowa. We're going to look for tax benefits, and we also want to look throughout the United States and throughout North America for places where we can find tax incentives. Maybe they're industry specific. Maybe they're states with low income tax. Maybe Texas is a good alternative, or maybe Florida. We also want to look at maybe some non-tax considerations, such as if working with unions will be beneficial or will be costly depending on our industry. We want to be very thorough when we look at location, because once you choose it, you kind of chose it. But there's many other important factors as well. The type of merger we're going to do from a tax perspective, we can certainly pursue a tax-free merger. But if we don't pursue a tax-free merger, we're going to be looking to get that step up in basis to utilize increased cost recovery, increased depreciation deductions. And if we're going to use debt, if we have a lot of cash on hand, we may not need debt. But if we're going to use debt, we're going to want to make sure that we maximize the tax benefits of our interest payments. We're also going to be looking at, we want to minimize transaction cost, tax leakage, as discussed in the Deloitte webcast. If we move assets across borders, if we repatriate foreign earnings to the U.S., we could be facing, significant tax there. There's an element of tax risk planning that we would also be looking at. If we're going to acquire a Midwestern firm, what are things that could go wrong? Is there any historic precedent, for other firms that have done the same thing? What are some issues they had? Can we learn from, past experiences? I want to kind of close up with two examples of some pretty high-profile recent merger transactions. The first one I'm going to talk about is a financial transaction. It involves Bain Capital buying all of the stock of Clear Channel Communications, the radio communication firm. And I've been pretty interested in Bain lately, just kind of trying to learn about Mitt Romney and stuff like that. But this Bain transaction was completed in 2008. Bain, it took 20 months to complete because I think Bain had some trouble securing all of the debt that they needed from banks to use the proceeds from debt to pay all of Clear Channel shareholders. The deal started in 2006, completed in 2008. Each of Clear Channel's shareholders agreed to receive $36 per share, and the total amount of the deal was $17.9 billion. It's pretty large, and now the new firm, is kind of, they're facing pretty heavy, debt payments as a result of the structure of the merger. But that's part of that, leverage buyout structure that's, at least in the past, been a pretty common financial acquisition strategy. We can kind of contrast that with the strategic strategy, which was completed in 2009, really between two giants in the pharmaceutical industry. In 2009, Pfizer completed a stock purchase of Wyeth. The goals of, we don't know what Bain's going to do with Clear Channel yet. The goals of Pfizer, I think, are kind of easier to speculate on. They're going to increase their market share because Wyeth has been a major competitor to Pfizer. Pfizer's going to gain access to Wyeth, proprietary procedures, and they're also going to be able to achieve some cost savings from their perspective by eliminating some redundant functions. Each Wyeth shareholder received $33 in cash and substantially one share of Pfizer valued at $17.19. They received 0.98 share of Pfizer plus cash for each share of Wyeth. The total value of consideration received for each share. It's just a shade over $50, and the total value of the deal was $68 billion. So, one of the largest mergers, uh, acquisitions post the new millennium. An interesting uh, characteristic about this agreement, the original agreement called for both Pfizer and Wyeth to repatriate billions of dollars of foreign earnings. And there's no question, some of these earnings may come from areas with lower tax rates than the United States or corporate tax rates. Um, if you have earnings being brought back from Ireland, where perhaps the tax rate was 5%, you could be looking at paying the difference between the 35% marginal rate and that 5% rate when you repatriate those earnings. So very substantial, but an important tax issue nonetheless. Um, in a more general perspective, though, it's M&A is an area that I'm hoping we'll see a lot more of as the economy hopefully improves. I'm going to be working with a lot of small and medium-sized firms in Columbus at the firm I'm working at, and M&A is a very strong priority of the firm I'm working at. So it's certainly one of my goals. After a few years of getting the tax basics down, I want to do very well, and I would love to kind of make M&A perhaps the niche of my career. So I'm going to continue to kind of be a student of it, and it's something that I'm looking forward to. So thanks a lot, Dr. Robbie. If you have any questions, definitely shoot me an email or something, and I'll be talking to you soon. Thanks so much.